call. So I just want to introduce Walt, who we all know, and he's going to teach us about credit and how to prepare our clients better and get them better credit scores. So I also wanted to go over, you know what, it's December 1st, you guys. We're like so close to hitting, getting out of 2020. Now, if you haven't already done it, now would be a really, really great time to set some goals and go over your business plan with your sales executive. So we have some great like goal sheets that we can go over with you guys. An interesting little tidbit is, did you know that people who write down their goals are 33% more successful in accomplishing them than people who merely formulate them in their minds? So for myself, I know this is to be true. I've always just thought about my goals and made goals, but never actually wrote them down until the last couple of years. And I've been hitting my goals every time now when I actually have a target. So I would love to work with any of you guys on setting your goals. Any of your sales executives would love to help. And I guess that's another thing I need to do is introduce my sales team, who you can't see them, but they are on call. We've got Heidi down in Albany, Annalise in Corvallis, and myself, Katrina, Kelly, and Cinda here in Salem, all ready to help you guys. And I also just want to say thank you for a great year and give you all a little gratitude. We've almost made it through this year. So with that, I'm gonna let Walt take it away and teach us something new, okay?
Perfect, thanks Tracy. Well, cool, well, sorry there. I had to text my wife. So, and guys, I'm sorry, I will be honest, my wife takes priority. So, all right, perfect. If you guys go ahead and switch your view there in the upper right-hand corner, one nice little trick with Facebook is that you can either show a gallery view, which will show Tracy and I'm sorry, not Facebook, with Zoom, that's what we're on. So you can have either a gallery view that will show Tracy and myself on there, or you can change to speaker view, and speaker view will then just show me. It will also show my slide and whatnot. So as I go ahead and share. So, all righty. So I'm going to go ahead and share my screen here, and we're going to rock and roll. We also have, want to give a shout out here to Susan Dunphy. Susan is on our team, and she is on the call here with us as well. And then also Tim Beck. So Tim recently joined our team. He was with Umpqua Bank, and we're happy to have him here too. So the chat section there is going to be live for us. We are going to buzz through credit pretty quick, as you guys know in previous classes that you've been in, that we do go through information really quick. So please, make any questions that you have in the chat box. We will get back and then answer those. So the credit company, really the slides were provided by My Credit Guy. And actually that's the company's name, My Credit Guy. And so Sam Parker. Sam Parker is the owner of My Credit Guy. And Sam is the guy that I use for all of our credit restoration type of things, fixing credit and whatnot. He's been instrumental in being able to help us get credit scores up significantly, whether it's a 550 to a 650 or a 650 to a 750, to be able to do that, to be able to help the clients either one, qualify for a mortgage, which is important, or two, be able to help them get a much better rate if we find something that is erroneous. So cool. Okay, so I'm going to go through here and share my screen. And you are going to see the slides over on the left-hand side, but that's okay. Actually, you know what? I'm going to stop the share here for a second, so then you don't see the side of my face all the time. I am going to share on the correct screen. Boom, there we go. Okay, so, and you should be, Tracy, you should be seeing this, right? You see my slide? Perfect, okay. Cool. So as we run through now, this is the first time that I've done this class, so bear with me a little bit. There's a lot that we want to cover. I'm going to read some slides, but also just really buzz through a lot of them. So what is a credit score? A credit score is a numerical expression based on a level and analysis of a person's credit files to represent the credit worthiness of the person. A credit score is primarily based on a credit report, information typically sourced from credit bureaus. So we'll go through that. Of course, you've got banks, you've got credit unions, you've got auto dealers, you have credit cards, you have personal lines of credit. You have all of those different companies that all report information on the credit bureaus. They give the information to the credit bureaus, which then gives us the credit scores. So we'll go through that information, and we'll talk about credit vendors, and then also why the credit scores are what they are. So FICO, I think this was a little interesting to me when I heard Sam talk about this, and I didn't know this. So FICO is a software company based in San Jose, California, and was founded by Bill Fair and Earl Isaac in 1956. Its FICO score, a measure of consumer credit risk, has become a fixture of consumer lending in the United States. So these two guys got together and they created FICO to be able to then send out information on credit scores and that. So we know that, and it's pretty common knowledge, we know that there's three different credit bureaus. So there's Equifax, which is the largest. There's TransUnion, which is the second largest, and then Experian, which is the third largest. And creditors don't always report to all three. The reason why they don't is because when they report, it costs them money. And so instead of costing them money, they may just only report to one or the other. That's why we start to see a fluctuation between the three different scores. So now what happens is that how we get our credit report is through a credit vendor. So we actually don't order credit reports directly through, through one of the three agencies. We always order through a vendor. And that's how everybody does it. We all have to order through a vendor. And then we get, that information is then pushed to the vendor. The vendor then pulls the credit, merges it all together to where we can see on any given account who reports, what they're reporting, and that. The credit vendor then provides us with either rapid rescores, which if you're familiar with what a rapid rescore is when something is incorrect on the credit report, the vendor will then obtain information to show that it's correct, go to the bureaus, get it fixed, and they will then rescore our account to be able to show what the credit scores will look like when it's all fixed. Now, that doesn't mean that the credit is fixed for the client. The client still has to go to the bureaus and get that information fixed. We've just done it on our credit report. That's it, just for our purposes. So if you ever have a client that does a rapid rescore, make sure that they repeat the efforts that we just did and make sure that they then send that information to the bureaus, whoever's reporting that. Now, that should be, the lender really should tell that client that they need to do that. Sometimes they don't. So it's important. And then the credit vendor also provides us with what-if simulators. And so we're able to see pretty darn quick if there's a collection and we pay it off, what will the score look like? If we pay an account down, what will the score look like? If we remove a 30-day late, what will the score look like? If we just wait a period of time, another 12 months or 24 months, what will the score look like? So we're able to see all those. And really the examples of the vendors would be Kroll Factual Data, Cisco, CSC, and some others. So lenders use all different types of credit vendors. There's not one benefit over another. Really, it's just a cost basis with the lenders. So, because of course we get charged every time that we pull a credit report. And So here's really how it looks. So we've got the creditor reports information to the 3 bureaus. The credit vendor then buys the information from the bureaus and compiles one report for us. The bank then buys the information. So it costs us $31.50 for a single pull, for a client. And then at that point, then the client receives the loan. So, I've tried before, when I get the credit report up, if I don't like it, I've tried to wipe the credit scores out there and put a new credit score in, but that doesn't work. So I'm joking. That's what my daughter would call a dad joke. But ultimately, the way to be able to fix those things would be, again, through a rapid rescore and whatnot. Or if it's pretty significant, then a lot of times what we'll do is we'll go directly to Sam there at My Credit Guy, and then he'll then start to follow the Fair Credit Reporting Act. He'll then send letters out to the creditors. He charges $299 to do that. He'll then start to send letters out, and he'll start to get things fixed. And he's able to hold them to the law at that point with the creditors. So next one here, of course, reading a credit report. As we go through the credit report, we get, I don't know if you really know how much information we get on a client. We get a lot of information on a client. And so with that, we get names, addresses, dates of birth, social security number, employers, and then any aliases that they've had. So if you've ever had a client that has said, has been at the closing table and they have to sign a document that shows how their name, any aliases that they've had, that's really where the information is coming from. So oftentimes we'll have a client that they have to sign something that says, my name wasn't like that. I never spelled my last name that way or whatnot. Well, it was somebody that misspelled the person's last name, and it's now on the credit report that way, and it's tied to the credit score when they pull a credit report. So they just have to say, I've never had my name spelled that way. I'll sign this document, but ultimately it was a misspell on somebody else when they pulled the credit. But it does show employers. It shows current address and previous addresses. It'll also show on our credit report, it shows phone numbers as well. So what phone numbers the individuals have had. And this is just a fictitious credit report here. But ultimately it shows, again, age, it shows city where they currently live. As we run down, it will show, their social security number. It goes through, date of birth here. And so, I'm sorry, that's when pulled on 9/15. So there's a little different credit report here. So it shows when it was pulled. It'll show us anybody that has ever pulled credit in the last 120 days. This is how the credit scores come through. It always comes through as 3 credit scores, and we use the middle of the 3 credit scores. So this one, there's 659, 633, and 597. I honestly never pay attention to these comments. The reason why I don't is because these are comments over the last 10 years. So if the client had significant delinquencies 9.5 years ago, it would show up here, numbers of accounts with delinquencies. So these are things that I kind of skim through real quick, but I really want to get to the meats and potatoes of the actual credit report itself. So as we start to go through the actual credit report itself here, we will see here whether it's a joint borrower, whether it's the borrower, or there would be a C here if it's the co-borrower. So this account would be joint between these fictitious people here, Zachary and Victoria. So this would be a joint account. This would be just Zachary's account. And then if it was a co-borrower's, just Victoria's, it would show a C. It shows the name of the borrower, of course, their account number. It shows the last date reported. So when the last date was reported that creditor reported the information, it'll show when they opened the account. So this shows really how long that account is, the length of account. It shows the high credit limit. And I will tell you that installment loans, like an auto loan, scores differently than a revolving loan. And there's a secret I'm going to share with you at the end with revolving loans that you really want to watch. And it's the difference between a score of, potentially like a 650, a 750, or an 800, 825. So good information. But ultimately, revolving loans will score differently. Installment loans like auto loans, mortgages, and things like that will score differently as well. Shows what the balance is, shows what the minimum payment is, and also how many months they have left on the mortgage. So, little known fact, if the client has less than 10 months on an installment loan, at that point, we don't have to count the debt against them, unless it's potentially a lease. If it's a lease, then we would have to count the debt against them because most likely they've got to go in and take the lease back in. But if it's just a straight auto loan, if it's a mortgage, if it's a installment loan that they bought some jewelry from K Jewelers, an installment loan that they've got a loan with, I don't know, whoever. Again, 10 payments left, we don't have to count. So it'll show if there's past due amounts, how many months it's been reviewed, and that is important. So that shows the length of account. Here you can see Chase had a late on 210, which 5 years ago, that's fine. But here it's a 99-month revolving account, which that's a good long account that they've had. Shows any lates that they've had here. Again, you can see Chase had one late in the last 30 days. And then it shows who is reporting this information. So for all of these accounts, Experian, TransUnion, and Equifax are reporting on all these different accounts. So that's something important to watch as well, because that, again, is what will determine credit scores, right? Where's my credit scores? Right here. It'll determine the credit scores here. So we know that TransUnion has a lower score for this client, for this fictitious client for whatever reason. So we need to start looking why that is. Why is Equifax showing a higher score? So we run through, and I've gone through borrower and that. So again, you've got borrower, co-borrower, joint, or authorized user. And I will tell you that I had a client not too long ago that had two accounts that his parents put him on, and he was showing as a co-borrower on the account, not an authorized user. But then we obtained the information from the creditor showing that he was an authorized user, so we're able to get that changed. If you're an authorized user, then you're not liable for that account. Thus, we didn't hit him for the payment for those accounts. So. And then these are numerical codes. I'll go over that here in a minute. So more, again, it shows the creditors here, which we've gone over. Date reported, date of last activity, high credit limit, revolving account or installment account, whatever it is. The balance and terms, whether it's past due, how it's been paid as agreed. So, and then these show the ratings here. Ratings are important because that then tells our credit guy the different areas and things that they can do to help. So, for instance, if it's not rated correctly, and this happens quite often, if it's not rated correctly, and there's a whole chart for all the different ratings, then that's where you really want to work with a credit repair specialist, not just a lender trying to do a rapid rescore or something, but a credit repair specialist, because if it's not reported correctly, the credit repair specialist can actually get that collection taken completely off the account. And so and they've got all the different codes and whatnot, and I can send the codes to you here. I took them out because they're kind of boring. So again, revolving, installment, open account, or mortgage, and that's where it would show right here. revolving. If it's a mortgage, it would show a mortgage. If it's an installment loan, it would show installment. And then here, so these are different of the different ratings that it should show. But ultimately on bankruptcy accounts, they remain listed as 9s instead of 7s. And we often find bankruptcy accounts as 7s where the creditor reported that the number to be a 7. And so we're able to get sometimes those accounts taken off. They should be listed as 9. I'm sorry, vice versa. They should be listed as 9s. And so we can get those accounts taken off because a 9 shows a different type of account, not a bankruptcy account. Foreclosures a lot of times are listed as 8s instead of 2 to 5s, and accounts with the past dates not rated as 1s still showing as past due. So, when an account still shows past due, sometimes we can get those accounts, when the client has caught them up and the creditor is still showing that account past due. Sometimes we can work with my credit guy to get those accounts actually fixed. And because they're reporting incorrectly, we can get those past dues all taken off the credit report. And I will tell you that just one 30-day late, I've seen it before, where one 30-day late has fluctuated the account by 100 points. That was on a mortgage, but one 30-day late can fluctuate an account quite a bit, whether it's 100 points, whether it's 30 points, 50 points. And when you're looking at a loan, understand that there's a breakdown in interest rate, and that breakdown is from a 780 to a 760, from a 760 to 740, 740 to 720, 720 to 600, and every 20 points there's a fluctuation on interest rates. And so it's not uncommon, specifically when you get down below 700, both FHA and conventional are now starting to hit the client pretty hard on their interest rate. And so we've seen interest rates in the 4% range, where right now we're seeing, in the high 2s, low 3s, we've seen them as much as 4% with a client that has a credit score down 650, 640, 620. The other thing is that credit score will fluctuate quite a bit and affect the mortgage insurance, unless you're doing FHA. FHA has a standard mortgage insurance they're going to charge, but on conventional, that mortgage insurance will fluctuate based upon what the credit score is. So, and the lower the credit score, the higher the fee. So, and yeah, I can go over that later with you guys. Or we can go over it one-on-one. I've got a little cheat sheet here that shows me the fees, and it's a little protractor thing. So anyway, so what is a collection? As we start to talk about really what is a collection and what do they look like and whatnot. So a collection is filed with the credit bureaus when a debt goes delinquent and no repayment has happened. And so a collection will hit the credit score. It doesn't matter if it shows a 0 amount, if it's still being reported, if it's a $500 amount, a $10,000 amount, the amount doesn't matter. It's the fact that there's a collection on that credit report that matters. So old collections, we want to make sure that they're not reporting anymore. New collections, we may want to get taken care of and we may not want to get taken care of. I'll explain here in a second. So charge-offs. A lot of times we'll hear from a client that, oh, I don't owe that debt anymore. It's charged off. They had a client that, or we have a client that maybe they went delinquent on their auto loan, and the auto, the credit union came and repossessed the car. They then took that car, went to auction, sold it at auction, and at auction, the amount owed was, the client owed $15,000 on the car, and at auction they got $10,000. So at that point, the client still owes that $5,000. Doesn't matter if it's been repossessed, whatnot. Doesn't matter that the bank took the car back. The client still owes that $5,000. The only way to wipe that out would be through a bankruptcy. So, but the client sometimes thinks that, well, I gave the car back, so I don't owe them anything. They still owe that $5,000. So as you fast forward, a year goes by, 2 years goes by, and the creditor doesn't get their money. So at that point, the creditor then will charge off that debt. So they'll take it off on their taxes. So as a charge off, they'll write off that debt as bad debt. And so they then get a deduction on their taxes for doing so. So on the credit report, it'll show that that debt's been charged off. And again, the client thinks, well, it's been charged off, so I don't owe it. No, you still owe it, unfortunately. And again, the only way to get rid of that is through a bankruptcy. So, and that's a common misconception that a lot of clients have is on a charge off that they still don't owe it. What happens is that the client either needs to declare bankruptcy, get rid of the debt, or they need to pay the debt. When they pay the debt, that money then goes to the original creditor, and then their creditor has to calculate that as income coming in, and then they have to take care of the charge off with the taxes and everything else. So, and then paying off a collection, it will drop your credit score. So I can't stress this enough. This is one area that I see a lot of misconception and a lot of bad advice given. So there's a way to be able to work with the collection. So when we get a file in, we're going to run the file through one of our automated underwriting engines. So GUS, DU, LP, whatever. And then that underwriting engine will tell us what collections, if any, that we need to pay off. So I can't stress enough, do not, make sure your clients know, do not pay that collection off during the loan process. So we can pay it off at closing and it won't affect the score. But do not pay it off during the loan process. So what will happen is that if that account, let's say that it's an account that has been there for 5 years and they stopped reporting 2 years ago. Well, at that point, that collection is still affecting the credit score, but it's not affecting the credit score a great deal. So it's really not tanking that score. It tanked it 5 years ago when it hit the credit originally, but now it's not affecting it a great deal. As soon as you pay that collection will count as a new collection. There will be new activity on that collection, which then now it will be reported, and then it will tank the score. So there's a little trick to this. And I've just learned about this, and so we're starting it out with some clients with Sam here. But ultimately, there's a little thing called, and I didn't know about this until just recently, a little thing called paid for deletion. And so where we have a client that then reaches out, or Sam, my credit guy, reaches out to the creditor, and it's on collections, and says, hey, if we pay the account, will you delete it from the credit report? Now, not all creditors will do this, but about 40% will. So if the creditor says, yes, we will, then whether it's the client or Sam, then the next response is, great, send me a letter to state that. And as soon as I get the letter via email or via mail, I will pay the account. And so as long as it's a paid for deletion, if it's a paid for deletion, then the second that you pay it, they will delete that account from your credit all in all. So that's the only time that I ever suggest paying off a collection during the loan process, because then that will help to raise the scores. We've had one client now that has done this, and it did increase scores. So great little tidbit, little secret there. So there is a statute of limitations on debt and on reporting. And so, and it's going to be anywhere from really 5 to 7 years. Whoops, sorry guys, 5 to 7 years in there. However, depending upon the state, and different states have different statute of limitations for reporting debt. A lot of states have the opportunity to be able to, and a lot of creditors have the opportunity to then bring that account back for another couple years, or, so if it's 7 years, they can add another 2 years onto it, or whatnot. So, we really don't get into a lot of this because the really old debt, we'll have the client pay at closing and then just satisfy it. But sometimes there's times where a client may have a lot of collections and we may get an attorney involved. The attorney that my team typically uses would be Lars Olson over at Olson Danes. And so we'll look at a possible bankruptcy where the client can declare bankruptcy and start over and move forward, or he may work with the creditors through the law and then get them to fix information. But this is an area on the statute of limitations. This is an area that Sam at My Credit Guy catches a lot of people at. So there's hard pulls and soft pulls on credit report. Hard inquiry is added to your report when you're seeking financing. A soft pull would be done through like a company like a Credit Karma. So let me go through here. So I'll talk more about Credit Karma here in a minute. Again, revolving accounts, those are going to be home equity lines of credit, lines of credit, credit cards, things like that, and they're going to score a little differently. Installment loans will be auto loans, student loans, mortgages. It could also be a personal line of credit. It seems like I get those announcements in the mail every day that they want me to borrow $50,000 and sign here and whatnot. So those are personal lines of credit. They're not tied to anything. So those would be installment loans. An installment loan is obviously any loan that you have a set amount of payments with a certain dollar amount. So bankruptcy, most loan programs require 2 years out of a bankruptcy. And there's really 3 different types of bankruptcy. There's a 7, an 11, and a 13. You'll never really get involved in 11. That's for corporations. But really the 7 is, 7 and 13 are consumer bankruptcies. A 7 is where you wipe out your debt. Now there are income limitations on who can file a 7. So if you've made too much income, the courts won't allow you to file a 7 bankruptcy. So they will require you to go into a 13. A 13 will typically be where you're paying the court, the trustee of the court, for the next 5 years on a certain amount that they determine as what you need to pay. It's really kind of a restructuring of debt, if you want to call it that. So then you've got a foreclosure, a deed in lieu of foreclosure, and a short sale. They all score differently as well. And I will tell you that on a bankruptcy, let me back up to the bankruptcy. You file a bankruptcy, that will tank your score. And so your score will go down immediately. You will start to get a lot of, if you're in a 13, it's going to be hard to start to recreate credit. If you're in a 7 and wipe everything out, you'll start to get credit card announcements right away, according to Lars. And so, because at that point, they know that you can't file a bankruptcy again for another 7 years. So therefore, you're going to start to get offers for credit. On a bankruptcy on a 7, it's important that person starts to rebuild their credit, and they start to do it right away. So then they can then buy in a couple of years. So, and we counsel a lot of clients with that information, and then we work with them on that. So on a foreclosure, a lot of times you're looking at really 3 years before you can do financing on these types of properties, whether it's a short sale, foreclosure, or deed in lieu. There are a couple little caveats to that. And obviously a foreclosure is when the client walks away from the house. A deed in lieu of foreclosure is where they give the title back to the bank, and the bank keeps all the equity, everything else. And then a short sale, of course, is where the sale has been short as to what they owe on there. So bankruptcies, short sales, foreclosures, judgments, liens, they're all public record. And that's why on a bankruptcy, The client will start to get a lot of junk mail and a lot of credit offers that, they'll get offers to buy cars and things like that. And so through that, you can start to restructure and start to build your credit again. A judgment is really, it's filed by an individual, or it could be by a company when money is owed. Now, I will tell you that on collections, when we have a collection on a credit report, a lot of times we need to have those collections paid off. And if you ever have a lender that's saying, well, this collection needs to be paid off, and it just doesn't sound right, it's probably because with that collection, there's a chance that that collection can become a judgment. And if it becomes a judgment, there's a lot of risk on the file. And if the client gets foreclosed upon, we have to pay that judgment off first before we ever get any money when we go to sell the house. So, so with that, if there's a judgment, 100% of the time, a judgment's going to have to be paid off. And so, and then we've got state tax liens. And so whether it's a state or IRS tax lien, a lot of times if a client has a tax lien, we'll go FHA, because FHA will allow that. Conventional has been a little more lenient on that as well, as long as the client has a payment, they're starting to make payments on the tax liens and whatnot. So as we go through, how your credit scores are derived, it's complicated. And so there's no perfect algorithm or score as to how it's done, but this is really what we've came up with thus far, which is 35% of your score is payment history, 30% is how much is owed, length of credit is 15%. Remember, I talked to you about that one Chase card that was reported for 99 months. That's big. And so new credit that you have is 10%, and then types of credit is 10%. So again, an installment loan is going to report differently than a revolving loan, and a revolving loan is going to report differently than an installment and a mortgage. So, but ultimately, that's really how it is. I mean, payment history is going to account for about 30 to 35% of your score. As we go through new credit, number of recently opened accounts, are going to be, we're going to be looking at number of recent inquiries. So if a client has a lot of inquiries, that's going to lower the score. You can see that they're starting to shop for whatever it is. Now, again, there's a caveat to that. So if we see a lot of auto dealership pulls within a certain period of time, and I believe that's 15 days, it will only count as one pull. So they changed that law back in around 2006, 2007, where it will only count as one. On a mortgage, there's a lot of lenders out there will say, don't pull new credit, don't pull new credit. And that's really a scarcity mindset, I feel, because, and ultimately that the reason for that is it used to change the score if you would pull new credit all the time. But on a mortgage, you can actually pull, I can pull that your credit a million times within a 30-day, and I've heard recently that it's now a 45-day period of time, and it will only count as one pull. So all of those pulls won't detract from the credit score. The scary thing is the clients out there shopping around, and do they work with us local? Do they work with Quicken? Do they work with whoever? That's kind of the scary thing on pulling new credit. So time and how long the credit inquiries have happened. So all that's going to account for about 10% of the score. Types of credit, again, 10%. Proper mix of credit is going to be important, and that. So, and then let me actually touch upon one point. Lack of any area can result in a score stall. So we've seen this recently where I've had a couple clients that we've applied for that have applied for a mortgage, and their credit, they didn't score at all. And they didn't score at all because their credit has now stalled. There's nothing to report. So they have credit that's old, they haven't used their credit. And after a while, if you don't use it, you lose it. So you will lose your scores. So payment history, again, 35%. Account payment information on specific types of accounts, credit cards, retail accounts, installment loans. Presence of any adverse public records will account for 35% of the score. So bankruptcies, judgments, any lawsuits, any liens, wage attachments. So also, the severity of delinquencies, whether it's a 30-day late, a 60, a 90, 120-day late. Recently had a client apply for a mortgage that had 120-day late on their mortgage. And so we can't do anything. Past amount due on delinquency accounts, collection items. So again, and it really goes to how much time has been there as well. Time since past due accounts, number of past due accounts, and then number of accounts paid as agreed. So that's 35% of the score. We've already seen that. We've already talked about that. Sorry, going back in slides here. Okay, so 30% accounts for amount owed. That's amount owing on accounts, account owing on specific types of accounts, amount owing on different types of accounts, lack of specific type of balance in some cases, number of accounts with balances, proportion of credit lines used, and that. And so, and then here's the last one, length of credit history. So that accounts for 15%. So that would be time that accounts were last opened, what type of accounts have been opened, time since account activity. Again, account activity is really important. And then the other thing is please do not, and please tell your lenders, do not have your clients close trade lines. Because if there's a trade line that's 99 months old, and they pay it off and then they go to close it, that can lower the score, because now you're taking that perfect history that they had on that account, the long time history of that account, and it's now moved down into accounts that are paid off, which are not scored. So, so that could really hurt them more than help them. So a couple of things I wanted to cover here. So as we go to, and this is really just kind of counseling at this point, as we go to, with credit, there's two things I want to cover. One is I want to cover the 50, 30, 10 rule. And I just mind blanked out on the second thing I want to cover, so it'll come back, I hope. So there's a rule that I just learned, and I'm calling it the 50, 30, 10 rule. And that is on credit cards. So let's say that you have a high credit limit. You have a credit card that has a high credit limit of $1,000. When I would not charge, if you want the best possible score, like an 800 or higher, I would not charge over $100 on that account ever. And I mean ever, because you don't know exactly when that account is going to report. So it doesn't matter if you pay that account off every month. It doesn't matter what you really do with that account. If you happen to charge, let's say $300 or $500 or $800 on the account, and all of a sudden that creditor then reports right at that time before you paid the account off, at that point, it will be derogatory towards your score. It'll lower your score. So this is why, when people are saying, I really want to be in the 800s, this is kind of the secret of how you get in the 800s. It's, you've got to pay, you don't ever charge over 10% on the credit card. And then whether you pay it off every month, that's not going to really help your score a great deal. If you pay a minimum monthly payment for a couple of months and then pay it off, then you're going to get a really high score, 800 plus. Now the second thing is that if you charge up to $300 on that $1,000 high credit limit, so you charge up to 30%, your score is going to be in the 700s, so 750 or whatnot, and so that's what it reports. So you're going to get a good score. You're not going to get a great score as you would with 10%, but you're going to get a really good score at 30%. Now, it's going to be detrimental if that client goes to 50% of the high credit limit. The second they hit 50%, the creditor then nails that client for the worst possible score that they can give them. They do that because they understand that at 50%, most people are starting to spend more than they're making. And therefore, the creditor then looks at that and says, well, I don't know if you're being wise with the credit, and you may be living beyond your means. And so they're going to hit them with a higher score at that point. So that's the 10, 30, 50 rule that I just recently learned. And so during a as we do the credit simulator, one thing that we've started looking at is instead of paying an account off, we'll pay it down, below 10%. And a lot of times that will give us a better score if the client will do that. And the other thing that I wanted to bring up, I'm not bringing to mind right now. That's one thing of not having an audience.
Well, I have a quick question, and you probably answered it, and I probably wasn't paying attention, but trade lines, what exactly is a trade line? Is that a credit card, or what is that?
Yeah, so trade line would be, anything that's reporting on your credit report. Great question.
Oh, okay. Just
so
anything.
it'd be a mortgage, it would be an auto loan, it'd be a credit card, anything that reports on your credit report is a trade line.
Okay.
So yeah.
So you don't run into risk of hurting your credit score by having too much credit?
No, not that I've heard and not that I've seen.
Okay.
Yeah, Credit Karma.
Okay.
Perfect. So yeah, not that I've seen. I have seen where clients, if they own a business and they get their credit checked a lot because of vendors, that's lowered scores. So some business owners where they pay everything on time or they pay everything off every month, I've seen scores like 730, 720, just because they have a lot of vendors that are checking their credit report, and that. And so, and that will happen until they can get some business credit kind of really established and going. So in that way that the vendors aren't checking a personal credit report.
Okay.
And let me talk about Credit Karma. So this is, I actually shot a video and I'm going to be shooting this video out here pretty soon. So Credit Karma is one of the burrs in my side. It is such of a pain in the butt. And to me, Credit Karma is, I'm sure, like Zillow is to you guys, where, I check my Zillow, right? And that really is my value, right? It's 100% correct. No, it's not. Credit Karma is one of those free agencies that you can go check. Now, we will send clients to Credit Karma because one thing that I really like about Credit Karma is it doesn't give you a credit score, and I'll explain why. But ultimately, what it will do is if we're trying to help a client build credit, they can go to Credit Karma, and then on Credit Karma, it will show them who potentially to apply to, that they're likely, more likely, I think it's more likely, less likely to get a credit card from that individual. So you go to the more likely people and you get a credit card. So if we need to build credit, it's a great place to go to be able to do that. There's a lot of really good information in Credit Karma. Now, the downside to it, the scoring models. Remember, FICO created, the scoring models. And so there's a FICO 1, FICO 2, FICO 3, 4, 5, 7, 8, and now there's a FICO 9 model. So there's a lot of models out there. Credit cards will follow a couple models. Auto dealers will follow a couple models. Mortgages, we actually have, I've heard as many as 5 to 6 models that we follow. So 5 to 6 of those FICO models we will follow. And so if it's a credit card, let's just say that you're getting your credit score from, they will only follow maybe 1 or 2 of those models, because if they give you $1,000 and you don't pay it, it's kind of like, okay, yeah, it sucks, but we didn't get our money and we didn't have a lot of risk out there, right? So they only follow 1 or 2 of those models. If it's an auto dealer, well, they're going to be a little more stringent, right? They're going to follow, maybe 2 or 3 of those models. And they're going to give you a little worse score than maybe what a credit card might give you, because they're going to be a little more stringent. They're loaning $20,000, $30,000, $40,000, $50,000 to a person. Now, granted, it's tied to that asset, but the reality is, when they get that asset back, if they have to, get it back from you, well, is it working right? Is it, did you beat it up or whatever? So they're going to lose quite a bit of money. So they're going to follow a couple more of those credit scoring models that maybe, a revolving credit card may not. Mortgages, we have the most stringent model. And that's why we have the most information as well. And so we follow, again, multiple of those FICO scoring models that then give us the score. And again, they just added a 9th scoring model, and they skipped like 6 or 7, one of those in there, but there's, and they don't have a FICO 1 model. So it starts off at 2 and goes all the way to 9, and they've skipped one of those in between. But the point is that on mortgage, we're going to follow it, and it's going to be the most stringent of those models. So hence, on on Credit Karma, they're not issuing credit. So they're going to follow 1 FICO model. And so, and I heard that's a FICO 2 model, which is the most lenient. And so it's you might also hear it as called a Vantage score. And so that's just one very lenient model. So therefore, a Credit Karma score is going to score really high compared to a credit card, compared to an auto loan, compared to a mortgage. Auto loans have a tendency as well to, even though they're following a couple FICO scoring models, they will follow the Beacon score, which a lot of times in our area is the highest score that a client will have. So out of the 3 different bureaus. So what other questions do you guys have here?
We seem to have a lot of questions. Can you read them? There's some in the chat and there's some in the Q&A.
Okay. So let me go through here. Okay, I see. Susan answered one. These are trade line. You asked about the trade line. We answered that one.
One was, how often do you see mistakes and why are they reported wrong?
Yeah. And just think of, really on that, we see mistakes all the time on credit. And if you think of it, I mean, how many millions of people have a Capital One credit card? And so, I mean, they advertise all the time. They have some great spokespeople, right? And so, but how many millions of people have that credit card? So there's bound and determined to be errors done, in reporting, because you have somebody who then has to interact with the computer to be able to report. And computers are fallible sometimes. And so, and of course, humans, we are very fallible sometimes. So we'll see a lot of times information that's not correct and we need to fix. The other thing is that if you've had a bankruptcy, or if your clients have had a bankruptcy, 9 times out of 10, there's going to be stuff that's erroneous on the credit report, where the creditor just, at that point, they get the bankruptcy notice from the court saying that, hey, this client declared bankruptcy, now they're untouchable and they declared bankruptcy on your debt. If they don't agree with that bankruptcy, they can go to the court and then try to overturn it at the court and say, hey, no, we are owed the money, and here's something that the client did fraudulently. But Lars tells me that at the court, like no creditors ever show up at the court. It's pretty darn rare that a creditor ever shows up at the court. So at that point, it's going to be overturned. The bankruptcy is going to be final, but now the creditor doesn't have any, they don't have any stakes in it anymore. So they'll just, a lot of times they don't fix the information. So they'll still show that the account's owed when it's not. They'll show that there's still missed payments on it when there are no payments due because the bankruptcy's happened. So so there's a lot of credit repair when a bankruptcy happens. It's not just a quick little thing. So great question.
What about medical debt? Does that still count against your credit report?
It does. So it's a collection. And on a lot of the medical these days, Fannie Mae and Ginnie Mae are not requiring it to be paid off. So again, we'll run through DU or LP, one of our automated engines, and then that will tell us whether or not that account needs to be paid off or not. We're finding a lot of medical accounts don't need to be paid off.
Okay. What about if your credit line is reduced for lack of use? Does that affect your score?
So the credit line being reduced won't, but if you owe money,
Changing your ratios.
Exactly, it changes the ratios. So creditors, a lot of times, if you don't use it but you owe some money on it, they will reduce the credit debt. Or if you're starting to get into, we've seen this where you're starting to get into a lot of debt, and then all of a sudden the creditor says, "Holy cow, you're getting in a lot of debt. Boom, we're going to reduce your debt to limit our liability." Now all of a sudden, instead of being at 50 or 60% of the high credit limit, now you're all of a sudden at 95% of the high credit limit. That will be detrimental to your score. So that's where, again, you really want to stay at, the sweet spot is 10%. If you're over that 10%, the next sweet spot is 30% of the high credit limit. As long as you stay within that 10 or 30% of the high credit limit, you're golden, you're perfect. So the second you get over that 30%, it's going to be detrimental. So yeah.
Wow. We have so many questions. I think we just need to do another class. I think one of them is people are wondering, like they get offers to raise their credit limit and they're concerned to do that, but really they should raise it as high as it goes, right?
Yeah.
Because that would help your.
Yeah. I wouldn't, if you get an offer, and it's kind of a mixed bag because, again, if you want to try to stay at that 10% level, the higher credit limit, if you're at, let's say that I'm on vacation, and on vacation, you want to use a credit card. And so it's for safety in that. Or maybe during Christmas, you want to use a credit card instead of your debit card, whatever. So 10% of $10,000 is $1,000. So if you have $1,000 credit limit, you can charge $100. And I know, my daughter and I went shopping for my wife last night for Christmas online, and we spent a little more than $100. And so, so if I'm trying to follow that 10% rule, it's going to be really hard for me to do that. But if my high credit limit is $10,000 or $20,000 or $30,000, and we've seen, accounts as high as $20,000, $30,000, $40,000, if we see those, then 10% is going to be much easier to be able to follow, so you can get the highest scores. So
one other question, sorry, I'm just trying to roll through these so we can get everyone off to do their things. By the way, you guys are all getting your credit. As long as you're on the call for the majority of it, you can hop off, but we do still have some more questions. And one here is, how long does joint debt or joint credit, like in a divorce situation, how long does that follow you?
I don't know. That's a great question. If you can afterwards shoot me who that is, because I'm not seeing it quick, just shoot me who that is. And the person that asked that question, I'll find out for you. And then Tracy and I will email you and just let you know.
And then another, like, where can people go to pull their credit? Because we're all supposed to be able to get one credit pull a year on our own. Is there a good place to go for that?
Yeah. So you can go, TransUnion is a great place to be able to go, and that. And so, and I would go, again, when you're going to the bureaus, you can go to any one of the 3 bureaus and get your credit report pulled for free. So the free report isn't going to give you everything that you're going to want you're really going to want, because again, it's going to follow just, 1 or 2 of those FICO scoring models, but you really want the paid one. The paid one will get you all the scoring models and get you a true credit score and give you all the information. So, you pay for what you get. Free, you're going to get some of the information. Paid, you're going to get all the information.
Okay.
So.
I think that covers the majority of it. Oh wait, I think I might have a couple more on here.
And guys, if you guys have personal questions and stuff, or other questions on that, just reach out to Tracy or myself. And Tracy, if you get any emails that have questions, shoot them off to me and we'll get them answered on a one-on-one basis. So.
Okay, cool. And another reminder, if y'all want to work on your goals and if you want a quick little goal sheet that can help you organize it, and your sales executive would love to sit down and help you plan next year because it's almost here. So, and you guys are all be getting your certificates shortly here. And yeah, thanks for showing up. And thanks again, Walt.
All right. Hey, thanks, guys. So we hope that this has been beneficial to you guys. And I really want to thank, I didn't do this at the beginning. I'm sorry, Tracy. Thank you so much for hosting the class for us. You're awesome. And, you know, education is near and dear to our heart. And I'm grateful that you support us in that.
Awesome. Thanks, guys. Bye-bye.